Hi everyone, welcome to today's video. So on today's video, I'm going to discuss with you about my favorite stocks. Now what is the reason why I'm making this video? So the reason is fairly simple, that the market is reacting in a very erratic way, so to say. That it's going up, it's going down, it's hitting new high, then someday you see Asian Paints fall by 7%, then someday you see HUL fall by a certain percentage, and it creates a lot of panic. So if we have a list of good stocks that we can keep handy, we can start investing in these stocks and start accumulating these good stocks at a dip. So I'm going to release part 1 today. These are few of my favorite stocks, not all my favorite stocks, but few of my favorite stocks. These are mostly buy and forget type of stocks for me. So I'm going to discuss that list. I've created a separate small case. Please go and check it out. Some of you are asking me that we are not able to access your small cases, Akshat. So what should we do? So please go and watch these small cases through the app on your mobile phone. So you will be able to access all these small cases that I'm talking about. Also, a very quick request that please watch this video till the very end. Only then it would make sense as to why I have picked these different categories of stocks. Towards the end, I will also talk about how to aggregate these stocks. So press the like button and we will get the video started. Now before I start explaining these 4 specific stocks that I am going to talk about, so let me outline the criteria that I have used to identify these stocks. So the first key criteria is sales growth. So all these companies that I'm speaking about, they have shown a general increase in sales. Now it's not like that, hey, 2020 did not impact these firms. Of course it did. But generally, over the last few years, the sales of all these different companies has been growing. So there has been a very clear uptrend in terms of the sales numbers. This is the first key and the very important criteria, because if a company is able to grow its sales, it's obviously a very good sign, because it plays into the market share. Because if the market share of a company improves, then the company gets a lot of opportunity. Its ROC improves, it can improve its operations, it can put that money back into running its operations, become more efficient, create more competitive advantage for itself. So improving sales is one of the key criteria that any company has. Now the second key criteria that I generally use for filtering good stock is the ROCE. ROCE means return on capital employed. So capital employed means that, let's assume that if I am a company, right? And then if you as a shareholder give me 100 rupees, that Akshat, here is 100 rupees, go and invest in your business and give us return. Then I take that 100 rupees from you, I use it for different things like hiring people, getting new machinery, signing new contracts, exploring new geographies, undertaking more marketing spend. So bunch of different things. So what is the return that I'm generating on the capital that I've procured from equity investors, right? So that is what ROCE means. Further simplified explanation would be that if you give me 100 rupees and if I'm able to generate 120 rupees out of your capital, that means that I'm generating 20 rupees for you, right? So all these companies have generated good ROCE, barring one, because that's a finance stock, and finance banking stocks work a little bit separate. So you can't judge ROCE parameter for finance stocks, because in terms of the money that the bank is getting, that is the capital for them. So the ROCE of banking stocks are usually low, and that's true for all the banks. Now the third key criteria is that the company should be debt free or should have very limited amount of debt. Now why is this such an important criteria for a country like India? Because in India the cost of capital is very high. What does that mean? It simply means, for example, on one hand we have the US government, and on the other hand, let's assume that we are talking about the Indian government. Now let's assume that you have 100 rupees to give from a safety perspective, where you will feel more comfortable giving or lending your money. We will give money to the US government because US is a more stable company. So the cost of capital for US, because it's more stable, it is going to be low. Similarly, in emerging economies, the cost of capital generally becomes high. So if you have companies that are surviving on debt, for example, you have telecom companies, you have power companies, you have infrastructure development companies, all these companies usually are very high debt oriented companies. Now debt is a double-edged sword. What does that mean? What it simply means is that if I'm taking 1000 rupee debt, and if I know how to invest that money properly, and if I'm able to do good things out of it, then great, I should be taking more and more debt and it is fine. But if I mess up those 1000 rupees and if I'm not able to turn that 1000 rupees into 1100 rupees, then I'm in trouble, because then I will probably go bankrupt if I don't have any backing. So in India, the phenomena is that, number one, the cost of capital is very high, and majority of the new entrants do not have a lot of cash in the bank. Therefore, it becomes difficult for them to survive if they are constantly taking on debt to run their company. Now, the fourth key criteria that I have used is that the company should have a good moat, MOAT. I've made a separate video on what moat is. So moat is some kind of a key advantage that other competitors can't copy. So there should be a very clear categorization. An example here would be Apple products. So I'm using an Apple laptop. Now there can be a bunch of different companies. For example, I can launch like Akshat Electronics. Now no one would buy the product because it does not have the same brand value as Apple. Now Apple is sitting on $1 billion cash. Why? Because it has built such a massive brand reputation that now it can charge insane amount of money for its product, and people like me who are stuck with the Apple ecosystem, they have no other option but to keep spending more of their money on it. So the bottom line is, so any company that you are investing from a long-term perspective, it should have some kind of a moat. So now let's talk about my 4 favorite stocks, not the most favorite stocks, but 4 favorite stocks. So the first stock is HUL, Hindustan Unilever. Now why am I so bullish about this company? I think one great article that I can share with you, and I'll put the link in the description box also. So please give it a go and give it a read. And I will go through this article with you. And it beautifully captures the essence of Hindustan Unilever. And it is a wonderful article about HUL. So what is HUL? Now, of course, they will say like good things. We have this purpose, that purpose. Agree, right? So, but this is not the moat, right? Now, the moat starts from here. Now, what is the moat for HUL? Now, HUL is literally building other brands. So, consider HUL to be an umbrella organization. Now, umbrella organization looks something like this, that you have a very big player at the top. Now, they have a bunch of different brands, right? So, brand 1 is there, brand 2 is there, brand 3 is there, so on and so forth. And each of these brands are popular within themselves. So let's quickly take a look at this particular paragraph. It will clarify a few points and things. So you can see that HUL has added famous brands like Horlicks and Boost. Now, do you know about Horlicks? Do you know about Boost? Yes. These are massive brands. The type of brand these are, everyone understands these brands, right? So what is the primary advantage? You will say that, hey Akshat, you know what? That HUL paid so much money acquiring Horlicks, they paid like billions of dollars. Is that not madness? Have they not taken like irrational expenditure? No, right? And I'll explain you why, right? So see, what is happening in India is that India is growing from a low income country to a mid income country, right? This is happening and this is bound to happen, right? It might take India 20 years. We can debate that it will take 30 years. Now, if you're someone who is invested in a company like HUL, what will they do with the brand, right? They will pick something like Horlicks. Let's say that a pack of Horlicks 100 grams costs 150 rupees, right? Can they not increase the price to 250 without taking a lot of hit on the sales? You tell me, right? Tell me in the comment box. They can. Very easily they can. Why? Because they have built out all these brands beautifully. In fact, very recently, and this is something that I have said on my videos also earlier, that HUL has recently decided to increase the price of its products by 12 to 15%. Which is massive, right? For an FMCG company to increase the price of its product to 15%, that is massive, right? So what is happening is that right now, as I've said on my earlier videos also, that we are in a high inflationary environment, right? High inflation environment. Now the prices of everything is going up. Now if the prices of everything goes up in conjunction with the inflation rate, then real growth is happening. Okay, let me explain that again. So for example, if the inflation rate is 6% and the growth of the company is 8%, then what is the real growth rate? The real growth rate is 2%. Now, so in India, let's assume that the inflation will remain at 6-7%. But if HUL can increase its product prices by 15% as it is doing, then the real growth rate of the company becomes 9%, roughly speaking. And that is a good growth rate for a company like HUL. And if you actually check the HUL chart, this is precisely what you will see. Why is the chart so smooth for a company like HUL? The reason is very simple, right? I mean, do you see any major spikes, right? This is the lifetime chart. We are seeing this uptrend, literally like it's moving in a channel, the entire price. This is as predictable a stock as it can get. This is a wonderful company, wonderful business to own, excellent management, have the pricing power, acquiring brands. India is growing. HUL will grow at plus 3% of India's GDP. So from that perspective, HUL is a wonderful business to own and it is definitely one of my favorite stocks. Now let me just round off the conversation around HUL by completing this article for you. Now, winning in many Indias. Now what does this mean? Now you might have heard of a story where in rural India, people do not buy these bottled shampoos. They buy sachets, right? That is called as product customization as per the customer, right? Now this is something that you're taught at good business schools, that you know how to do human-centered design intervention, HCD designs. Now what that means is that you go and research about the customer. What do they want? What exactly is it that they are looking at? What kind of problems they face? So what is the major problem in rural India right now? The major problem in rural India is that people don't have a lot of discretionary cash. If HUL is trying to sell them shampoo It's going to cost 150, 200 rupees for a rural person to buy that shampoo. They can't do it. They don't have that much money to spend in one go. But if HUL starts selling shampoos at 1 rupee, 2 rupee sachet, then they can do it. So that is how you customize the product as per different audiences. And a brand like HUL has been a master at it, and they have been doing it wonderfully well for different geographies, understanding customer preferences, launching and designing products accordingly. Now let me take you through another very key important point, which is designing a digital backbone. This is something that even I did not have a very clear understanding of 3-4 years ago. Then I worked with a client of mine. He built the P&G's Russia supply chain, right? He actually got into INSEAD Business School and now runs his own venture. But by working with him, I understood the nature of the work and I got to learn a lot about how these supply chains are designed for these FMCG companies. Now, the wonderful part is that these companies have excellent retailer and distributor network. There is something called as shelf space. Now, if you're using logistics, that if you can supply the material at the proper time, if you can supply the right type of material at the right time, if you have big database of what is being sold versus not, how to design the product, what is being perceived good versus bad in the market, how to design different interventions between West Bengal and Orissa, how to design different types of interventions in South India versus North India. These are all aspects that goes into designing the supply chain. And this is all data driven. And companies like HUL, they have very sophisticated infrastructure in terms of developing this database. And therefore, they have massive moat compared to any new entrant that is coming into this business. Now, I will link the article in the description box. You can read it more. But these were some of the key points that I wanted to discuss about HUL. I will not take you through the financials. It's wonderful. There is no point in me doing that again. You can read the financials on your own. But let me now talk about my second favorite stock. Is HDFC Group, and I am invested in almost all their companies. HDFC AMC, HDFC Bank, HDFC Life, and finally HDFC itself. Now this is one of my bigger investments in a particular group. Now, what is the moat for HDFC Group in total? Okay, the moat is the following, and this is what people miss. Now, similar to Apple, Apple designs an ecosystem, right? That they will sell you a laptop. Then you have an iPad, then they will sell you AirPods. Now you can switch very easily between like device A to device B. That is the ecosystem play. It improves convenience for the customer. Therefore, they get stuck with the Apple ecosystem and then they don't switch. So what is it that HDFC is trying to do? Pause the video and try to type out your answer in the comment box. What exactly is it that HDFC is doing? So HDFC is building an ecosystem play in the financial service industry. Right from bank is something that has grown massively for HDFC. Now, they have increased their presence through AMC, asset management company, HDFC AMC, that has become big. They are into insurance space is consolidating now, and they are into housing finance also. HDFC is a housing finance company, so to say. Now, you'll say that, okay, you know what is the benefit of this ecosystem? I don't get it. Okay, so here is how it goes. So you go and open your bank account at HDFC. They get your data, right? You have a relationship manager. That same relationship manager sells you insurance. That same relationship manager calls you and says that, you know what, you have like 5 lakh rupees lying in your bank account. Do you want to create a fixed deposit or do you want to transfer it to this particular company and buy this new scheme that we are launching? Or you want to transfer that money to this particular asset class that will give you more return than FD. Then you will go and indirectly invest in the HDFC scheme. So the bottom line is that this entire system is set up in such a wonderful way that they do not have to take massive spend in terms of CAC, customer acquisition cost. Customer acquisition cost in finance is one of the biggest costs because getting a relevant customer is the hardest job for any finance company. A bank spends so much resource. Why do you think that bank managers during Diwali come to your house, right? In my case, my bank manager is like after my life that, you know what, Akshat, just give us some time. We want to come and meet you, this, that. I know what the agenda is. They just want to aggregate all my accounts into HDFC. That is the same conversation that I have with them every single time that no, I'm not going to keep all my accounts in HDFC. But back to the topic, the concept is that CAC, customer acquisition cost, goes down. And these portfolio companies of HDFC, now I don't have data to prove it, but I can assure you, they are sharing your data with each of these groups and you'll be sold more and more of those services. Now you will say that, you know what, this looks like a very fishy, multi-level marketing type of a scheme. No, it's not bad. I'm saying it in the best possible way because HDFC Group is so good in terms of customer engagement, customer interaction. Unlike some of the other banks, you can comment which those banks. I'm not going to tell a joke again today. But the bottom line is, but the real moat of HDFC is that they are able to reduce that customer acquisition cost and retain that customer by providing good services. This, according to me, is an advantage that will continue to keep HDFC at the forefront. And this is the reason why I'm heavily invested in the HDFC Group. Now I've made a separate video on HDFC. You can do the entire analysis there, but the objective of this video is to give you a quick information about all these major stocks and help you understand fundamentally why these stocks are solid. Okay, moving on to the third stock that I'm very bullish about. Now this is a mid-cap stock and it is one of my favorite stocks, which is Equitas Small Finance Bank. Now you would say, Akshat, okay, small finance bank, why are you so bullish about Equitas Small Finance and how does it exactly differ from something like HDFC? Okay, so the customer group that HDFC is catering to would be rich to like middle class. That is the group that they are catering to. Now Equitas, consider it like a mini HDFC. They are catering to a completely different set of audience. They are catering to low income people who want to start their businesses. It started out as Equitas Microfinance and now they are giving full-fledged loans to start business operations for low-income people. For example, there are a lot of people who move from villages to city and start small businesses. For example, they will become fruit vendors, or they will buy an auto, or they will start a small printing business, bunch of different things, right? So they do not have the credit worthiness to take loans from HDFC Bank, but Equitas Small Finance is financing them. I will say that, okay, this is like a normal business model. What's so great about that? So let me compare Ujjivan Small Finance with Equitas Small Finance in terms of their loan breakup. Now this is a chart that you can see for Equitas, and here you can see that they are giving small business loans including housing finance, and this stands at 44.5. Now let's look at Ujjivan Small Finance. How much loan is it giving in MSE? So it's giving 8%, and these group loans are microfinance loans, not necessarily business loans. So this is an important consideration. So what I'm getting at is that if you take a look at Equitas Small Finance Bank, they are more business oriented. They are financing businesses. What that leads to is that, for example, if I am from a village, I go to a city and I start my own fruit stall, then my fruit stall does well. What would I do? I will call 4 of my relatives from a village that, you know what, business is doing really well. Come and start your own businesses. Now what this leads to is word of mouth advertising. And guess what? Where are these people going to take loans from? Equitas, right? Then what happens? That I was able to run a very good fruit stall and I was making money. Now I want to buy a bike. What would I do? Then I will go to the same bank. So therefore you see that even that vehicle financing for Equitas is also very high. Instead of doing micro loans per se, they are giving more business oriented loans. And this is a great strategy that Equitas has applied. Now as India gets more and more entrepreneurial, there is more need for small businesses. Equitas is very sensible in terms of how they are growing. So I'm quite confident that even the quality of their loans is very high. Now, let me share very quick numbers about Equitas. So you can see there has been a constant growth in Equitas revenues. That's criteria 1. Profits have generally grown, right? The pandemic year has been bad, no doubt. The net profits have also grown. It was a last pandemic year, bad stuff because of that. But Equitas is growing sensibly. And if you take a look at cash flows, again, you can see that the cash flows have been positive. It means that they can reinvest all this money into growing their banks or chain of banks, which is really good for a company like Equitas. Okay, now comes my final favorite stock, which is Page Industries. I have made this video earlier. Since the time I had made this video, this stock has gone up by 15-20% already. There were a lot of people commenting that, hey Akshat, Page Industries will not go up, this, that. No, right? There is a reason why a stock like Page Industries will continue to go up for a substantial future. Now, this is not a buying recommendation. These are my viewpoints. Okay, so what is the moat for Page Industries? Before I talk about that, let me very briefly explain what Page Industry does. So essentially, it's an innerwear brand, for example, Jockey, Speedo. These are some of the key international brands that Genomulls have brought into the Indian market. They manufacture it and have exclusive licenses to sell these products. That is the business model. So the moat of this company is very high ROC. So let me share the ROC number and you can see that the ROC is 48.2%, which is massive. This is very high ROC. Now, why is it that a company like Page Industry has such a high ROC? The reason is very, very simple, and the reason is this. A, they control distribution and retail networks really, really well. They give a lot of incentives to people. Please check my analysis on Page Industry. I made a separate video on this. So I'll not speak a lot here. But to cut the long story short, their distribution and retailing mechanism is very, very strong, which gives them a lot of legroom in terms of growing very rapidly. They have exclusive contracts in terms of building a distribution network, and they have figured out a way to keep their distributors and retailers very happy. Now, number 2 is the nature of the business itself. For example, why do you think that a company like Page Industry stuck with Jockey for such a long period of time? Why did they not go and expand like 50 different brands? They had made Jockey successful, and Jockey has been a fairly old brand in India now. Why did they not go and aggregate 15-20 more brands? The reason is very simple, that they wanted to specialize in one single business first, be really great at it. For example, HUL is a branding play. They have increased their brand value so much that they can charge insane amount of prices now for their product in the FMCG space. Similarly, Page Industry has tried to build the market base for a brand like Jockey, made it really shine, optimize their manufacturing, right? Squeezed every single dollar out of it. Then they optimize their distribution and retailing, squeezed every single dollar out of it, optimize their marketing. Now all of us know Jockey, now they have entered into Speedo. So their objective is to grow profitably, right? This is something that billion-dollar startups who are launching their IPO miss, right? They will do one thing 1 year, then next year they will start doing something else, then in third year they will do something else, and then they will call that, hey, you know what, we have aggregated like 500 million users. Okay, great, but where are the profits? Then they will say that, okay, you know what, we are just in the user acquisition grade. Then they will say that, okay, you know what, we are just figuring out our business model. We are not yet focused on profits. Okay, this is insanity. You have been in existence for the last decade. You're not focused on profits. What sense does that make? Okay, so back to Page Industries, the moat is very simple, that they are optimizing their business in such a way that if another company tries to launch something like Jockey, they can't beat Page Industry in terms of the ROC. That is the simple game. Now, the more money Page Industry makes, the more it can go and reinvest that profit into growing their company. So this is called as organic growth, and any company that does it well creates so much barriers to entry that it literally becomes a monopoly in that brand. Alright, so before I close out the video, now you would have an obvious question that, Akshat, these are all great stocks. What should I do? Should I buy it tomorrow when the market opens? No. Wait for a dip, wait for a little correction. If there are any technical indicators, follow that. I'll keep on highlighting some of these key points. Right now, HDFC, AMC, HUL are at a great buying level. I had given calls for HDFC Bank few days back. I have given calls for Kotak Bank few days back. I hope some of you would have benefited from that after doing your due diligence. I will keep on adding more stocks to this small case. Please keep a lookout. It will help you understand what good stocks I'm looking at and adding to this portfolio. It will follow the same criteria that I've spoken about on this video. So I hope you enjoyed this video. Share it with your friends and give it a thumbs up, and I will see you the next time.